For the last 36 years, one tactical strategy has consistently outperformed pure momentum approaches during the exact market conditions that break them. Choppy sideways markets. Correlated crashes. The 2022 bond stock reversal. While classic momentum strategies whipsawed and lost, this approach gained. Its core idea is counterintuitive. Instead of chasing the assets that went up most, it sizes positions based on how much they fluctuate. Less volatile assets get larger allocations. More volatile assets get smaller ones. The result is a portfolio that behaves like a shock absorber. This is Kipnis Defensive Adaptive KDA, developed by Ilya Kipnis starting in 2016. Here is the problem every momentum-based strategy shares. Momentum works beautifully in trending markets. Uptrends stay up, downtrends stay down. You ride the trend and make money. But markets are not always trending. Sometimes they grind sideways for years. Sometimes they reverse sharply, sometimes everything correlates to one. That is the technical phrase for every asset falling together. In these environments, pure momentum strategies whipsaw. They buy at local highs and sell at local lows. They chase signals that reverse. Over 36 years, the best momentum strategies still win, but they absorb years of painful whipsaw along the way. Ilya Kipnis, writing at QuantStratTrade starting in 2015, asked a different question. What if you size positions based on realized volatility rather than returns? Not what went up, but how stable was its path up? That question produced KDA. KDA is a volatility-weighted tactical strategy with an adaptive defensive overlay. The design philosophy is fundamentally different from every strategy we cover on this channel. Instead of ranking assets by momentum and picking winners, KDA allocates inverse proportional to volatility. Less volatile assets get bigger positions. More volatile assets get smaller ones. This is called inverse volatility weighting, and it has a long academic history going back to the risk parity literature of the 1990s. Kipnis then overlays a defensive rule. If the overall market breadth is weak, meaning too few offensive assets are trending up, KDA scales down exposure proportionally. The result is a portfolio that never swings hard in any direction. Quiet during crises. Modest in bull markets. Consistent across regimes. It was specifically designed to handle the environments where other tactical strategies struggle. Let me walk you through the actual mechanism. KDA uses a basket of offensive assets, typically 5 or 6. Large cap US stocks, small cap US stocks, international developed markets, emerging markets, real estate, commodities. Every month, for each asset, you calculate 3 numbers. The 12-month simple moving average momentum. The realized volatility of daily returns over the last 60 days. And the canary breadth signal, meaning how many of the offensive assets have positive momentum. Step 1. For assets with positive momentum, calculate the inverse of their volatility. That is 1 divided by volatility, normalize so the weights sum to 1. That is your offensive allocation. Step 2. Apply the defensive overlay. If all 6 offensive assets are positive, keep 100% in the weighted defensive portfolio. If only 3 are positive, put 50% in defensive bonds. If 0 are positive, 100% bonds. The defensive allocation scales linearly with breadth. Step 3. Rebalance once a month. The whole system is rule-based, with no manual parameter tuning. KDA is one of the most computationally explicit tactical strategies, and that is by design. Over 36 years, from January 1990 through March 2026, KDA delivered a compound annual growth rate of 9.5%. The S&P 500 returned 10.6 over the same period. So KDA slightly underperforms the S&P on raw return. But the risk profile is dramatically different. Maximum drawdown of just -11.5% compared to the S&P's -55. Volatility of 9.8%, a little more than half the S&P's 17. Sharp ratio of 0.95 versus 0.6 for the S&P. Sortino ratio of 1.35, Kalmar ratio of 0.84. These are risk-adjusted numbers that rank among the best tactical strategies ever documented. $100 invested in 1990 grew to about $2,800 by today. The S&P reached about $3,600. KDA gives up about $800 of final wealth compared to buy and hold, but with 1/5 the worst-case pain along the way. Here is what 36 years of KDA looks like. The cyan line is KDA. The gray line is the S&P 500. The pattern is distinctive. For long stretches, KDA underperforms the S&P, particularly during strong bull markets. You see this clearly in the late 90s tech boom, the 2003 to 2007 recovery, and the 2010 to 2019 bull market. In each of those periods, KDA trailed by as much as 20 percentage points in cumulative terms. But then the crashes come. 2000, S&P down 49%, KDA down 8, 2008, S&P down 55, KDA down 11.5, COVID 2020, S&P down 34, KDA down 6, 2022, S&P down 25, KDA down 7. Each crisis is where KDA recovers the relative performance. Because KDA never loses much, it does not need to recover much. Over 36 years, the equity curves end up in similar places, but KDA got there without the crashes that made most investors sell at the bottom. Now let me give you the real picture. KDA has 3 honest trade-offs. First, sustained underperformance during bull markets. KDA is structurally biased toward low volatility assets. When high volatility assets like tech stocks rip, KDA is barely in them. 2010 to 2019 was one of the longest bull markets in US history, and KDA trailed the S&P by 9% per year during that stretch. Compounded over a decade, that is more than twice the money of the S&P. Watching a quieter strategy underperform for 10 straight years requires patience most investors do not have. Second, the complexity penalty. KDA uses volatility calculations, inverse weighting, breadth signals, and defensive scaling. The mechanics are explicit, but not simple. You need to trust the mathematics rather than verify it visually. Third, implementation friction. Monthly volatility calculations require daily price data, not just monthly closes. You need more data pipeline than other tactical strategies. Most retail tools do not calculate realized volatility on the fly, so you may need to script your own implementation or rely on a platform that tracks it. Let me walk through how KDA handled each major crisis. 94 bond route. Stocks flat, bonds down. KDA's volatility weighting had allocated heavily to bonds, which hurt. Lost about 4% for the year. 97 Asia crisis. Emerging markets crashed 40%. KDA had reduced EM weight because of rising volatility. Minor impact. 2000.com crash, S&P down 49% across 3 years. KDA's breadth signal went defensive in early 2001. KDA finished the period down about 8%. 2008 global financial crisis. Breadth signal triggered full defensive allocation by October 2007. KDA lost 11.5% for the full GFC period against 55% for the S&P. COVID 2020. Sharp crash, sharp recovery. KDA was partially defensive before the crash because emerging markets had been weakening. Lost 6%. 2022 bond stock correlation crisis. KDA's bond allocation hurt, but the defensive overlay prevented severe losses. Lost 7%. 6 major stress tests. KDA's largest drawdown was 11.5%. KDA is built for a specific kind of investor. First, people who specifically value risk-adjusted performance over raw returns. If your utility function weights drawdowns twice as heavily as gains, KDA dominates nearly every other tactical strategy. The Sortino ratio of 1.35 is among the best of any strategy, with a multi-decade track record. Second, quantitative investors who trust mathematics over intuition. KDA requires volatility calculations, inverse weighting, and breadth arithmetic. If you prefer to understand the numbers deeply before deploying capital, KDA is rigorous enough to reward that analysis. Third, people with the psychological stamina to endure long stretches of underperformance. KDA can trail buy and hold for 5, 10, even 15 years during strong bull markets. You have to hold the strategy through that discomfort to capture the crisis protection benefit. Fourth, Investors managing larger portfolios where downside protection has outsized value. The difference between a -11% drawdown and a -50% drawdown is hundreds of thousands of dollars on $1 million portfolio. If you want to implement KDA, BestFolio tracks the live volatility weights and breadth signal every month. You see exactly which assets have positive momentum, their current 60-day volatilities, the inverse weighted offensive allocation, and the defensive scaling factor. Full backtest data goes back to 1990. Over 80 other tactical strategies tracked at the same level of detail, including the momentum-based strategies KDA was designed to complement. Link in the description. If you found this useful, subscribe. I break down a different strategy every week, with real data, honest trade-offs, and no hype. Next week, a strategy that combines momentum signals with multiple timeframes for greater stability during regime changes. See you then.